And now, here is the host of the Faber Report, David Faber.
Thank you, Johnny Gilbert. All right. Yeah, there we go. I'm back to you. Guys, I want to talk about SPACs. And you know what? Let me give you a quick rundown on where we're going to hit first here. Bill Ackman, again, remember the largest SPAC out there, actually one of the more favorable for investors in terms of at least an alignment of incentives with the actual SPAC holders for Tontine. But we're going to talk about Bill Ackman's SPAC. We're going to talk about the lawsuits. I reported on this yesterday. I want to clarify some of those things. I want to talk about minimum cash requirements in SPACs. This is coming up a lot lately, given the very high level of shareholder redemptions. All right, first to Ackman. He put out another letter basically saying, listen, he's going to try to move to a SPAC, which is a new vehicle he's creating that he wants to get the SEC to sign off on. If it's approved by the SEC and he gets the SPAC warrants as well for listing, he says, then, you know what I'm going to do with PSTH? If we haven't actually entered a merger transaction, I'm going to give you your money back, all $4 billion of it. And then you're going to get an opportunity to participate in the SPAC, which is different. They don't take your money. It's kind of an option to participate in a future deal. It would be a new structure. Remember, Ackman's SPAC was so large, it made it very difficult to find a potential target. He talked about things like Bloomberg, which I've reported is not going to happen, and any number of others. It does seem likely he's going to give the money back. But again, to his credit, at least the incentives there were much better aligned with that of his SPAC holders. And I want to get to that in a bit. Let's go back to the lawsuit. Remember, one of the reasons why Ackman is doing this is this lawsuit that they got, saying that they should be regulated under the 40 Act as an investment company. Yesterday, I'd reported on what might be a proliferation of those lawsuits. They're not going to come, though, from the people suing Ackman. I can tell you that at this point. However, I am hearing from any number of SPAC sponsors. They've been contacted by lawyers. It's unclear at this point, though, whether these are simply plaintiffs' lawyers that are going to be following up with similar arguments without great merit. But it does have a chilling effect on the SPAC market overall, Jim. And it will, remember, time is your enemy as a SPAC sponsor. You want to get your deal done and approved or announced and approved. So we'll keep an eye on that. But I did want to back off a bit yesterday from indicating in some way that Mr. Jackson, the former SEC commissioner, and any of the people who are suing on Tontine are going to actually broaden out. That is not expected to be the case.
But the chilling effect is very real.
But the chilling effect could be real. You could have a lot more plaintiffs' attorneys. And again, I know a lot of sponsors have been contacted by lawyers. All right, let's move on to
that's news.
Let's
people
move on
should understand
to an interesting move today in a particular stock. Which is not one I've ever talked about. LWAC is what I'm talking about here. It's Locust Walk acquisition. We'll take a look at the stock if we can, because this is going to get to look at that. What's going on here? Well, there's I wouldn't say new, but there is a relatively new phenomenon here. You're getting enormous redemptions in many of these stocks, in many of these SPACs. In other words, shareholders saying, you know what, I want my $10. I want my 1010, whatever the redemption price might be. And yet they are still voting in favor of the deals, but it is having the effect of reducing the actual cash that is coming in to the company once they actually affect the merger, not to mention it is vastly reducing the amount of shares that are actually outstanding. Couple this with what has been a recent trend amongst investors to short SPACs that are about to close their transaction in the expectation that, in fact, it might move lower. And what do you have? Well, let's just give you the numbers on Locust Walk, all right? 71.7% of the shares were voted in favor, of outstanding shares voted in favor. Deal was approved. But you know what? 17 million shares were redeemed. What was that as a percentage? It's like 95% of the shares were redeemed, Jim. I want my money back, even though I voted in favor. And what did that have the effect of doing? Well, anybody shorted suddenly finds themselves today saying, wait a second, I can't borrow this stock anymore. I can't cover. What am I going to do?
It doesn't exist.
It doesn't exist.
Oh, my God.
I got a huge short squeeze on my hands. All these shares that I expected would be outstanding are gone.
It's terminal.
Yeah. Now, by the way, it also had the effect of vastly reducing the amount of cash that was available to the company that LWAC, Locust Walk, was acquiring. But they waived the minimum cash requirement. They said, all right, we'll make do with the $5.2 million that's coming in. We'll add that to what we already have. We'll have about, $60 million total in gross proceeds. That's well below the $100 million we anticipated having. It's the company, by the way, that needs to waive that minimum cash requirement. The sponsor doesn't. But then, guys, I just get back to the misincentives, the lack of alignment in incentives.
Oh, my God, Gary
So many
Gensler.
of these sponsors,
Gary
Jim,
Gensler has to
and Carl,
stop this.
You know, still, I find they don't seem to be. Why aren't they renegotiating deal prices down? Because they want to get the deal done no matter what. Why? Because even if it goes to 5 or 4, they are still going to make money, even though you as a holder might be down 50%. They don't renegotiate deals. Take a look at the background to some of the transactions of these deals. Look at the amount of due diligence that was done. Look at the lack, frankly, of overall information we get in terms of any transparency. There just continues to be a misalignment of incentives. And it's a very basic one. Not for pipe holders, by the way, who also are on the line here when these minimum cash requirements aren't met because of these high levels of redemptions. But it's something that we continue to have to watch.
How the
Not all
sponsors doing?
SPACs are bad.
How sponsors doing?
Sponsors make money, even down to very low levels. And that's the key here.
Okay, so go ahead. Not all SPACs are bad.
No, they're not. There are some deals that make sense, that are funky in some way, that wouldn't make them appropriate for the public markets in a typical IPO. But there are so many that we have to keep a closer eye on. Finally, let's go to all our SPAC indexes. You've taken a look at it. The CNBC SPAC 50 you're looking at right there, that is the 50 SPACs that haven't announced deals. All right, so they're trading ever so slightly above par. We got the deal index. Those are the ones where you've already announced the deal, but you haven't closed it. And that's well below par. And then you got post-SPACs, where we keep an eye on how do they actually perform once they close the deal. And those aren't doing well either.
Remember, this is an S&P that's up gigantically. So if you just had it in S&P fund, you've crushed these guys.
But there's a lot of arbitrage available as well. You can get 4 times leverage on a redemption. In other words, something's trading at $9.60, let's say, and you buy it, you can get 4 times leverage. All right, it's a spread. You might get delayed, but it's kind of not a bad rate of return for some of these
famous
things.
name SPACs, the people who are not really business
Not
people.
great. Not great. So many of them not perform particularly well. I mean, huge money has been made. Michael Klein's of the world, Chamath's of the world, Bill Foley SPACs.
Ooh, I get
Not
asked
good at
about
all.
them constantly.
They have not worked.
Money.
They have not
They've
done
been
well.
bad, but that wine that he has in that ad,
The wine is nice.
white chalk, what is it?
Wine is good. He's a great guest, but those SPACs have not been performing well.
No, I mean, I don't mean to joke. There's some serious money lost in this. I mean, serious.
So we'll be keeping an eye on
And it's not
things.
like you didn't tell people.
No,
that
we
this
talked-
couldn't
we
happen.
talked a lot about it.
You said this was going to happen.
It goes back to that basic misalignment incentives. The SPAC sponsor is perhaps even incented to pay up, to get in a SPAC off, to pay more than they should have, and then not necessarily renegotiate a deal down.